Well, hello, everyone. We want to welcome you to our Plan Series webinar. This month, we're going to be talking about investment fundamentals. So a little bit about myself as we get settled today. My name is Justin Baumgren, Certified Financial Planner and owner of Baumgren Retire Plan. Today, we're going to talk about the basics of investments. We're not going to go over stock picks or some hot stocks to choose for your portfolio. We're going to talk about the building blocks, the fundamentals in building a good portfolio. We've got a lot to cover today, but if you have some questions, feel free to put those in the chat. We can try to address them if we have time at the end of the program. Why it's important that we're discussing this now, you can see the news and see how volatile the markets can become. Also, as we try to achieve our financial goals, oftentimes investing plays a major part of that, as CDs, savings rates, money market accounts have such a low yield on them. So for many, even some basic investing involves savings, involves some sort of investing. So we hope you benefit from our discussion today. But talking a little bit about investing, we might think about monopoly a bit here. So do we want to be the investment tycoon like we're playing Monopoly? Is that the goal of investing? Well, interestingly, notice this. This is a quote from Wikipedia about the history of Monopoly, the game. Monopoly is a redesign of an earlier game, the landlord's game, first published by the Quaker and political activist Elizabeth Magie. The first of that game was to teach people how monopolies end up bankrupting the many, giving extraordinary wealth to one or few individuals. Really isn't that the premise of the game, but many of us may not have known that the game Monopoly was to teach a vital lesson, a harmful lesson. So what is then the goal of investing? Well, it's certainly not that of playing the game of Monopoly. The goal of investing in good fundamentals, the building blocks of investing, has more to do with mathematical equations and emotion, balancing those. Well, what do we mean by that? Okay, well, let's first off talk about oftentimes the emotional aspects of investing. So we can pick up the news or Apple News, TV. In any given day, there's something in there that may cause us fear. The sky is falling. Home values today are very high. You may wonder, should we invest in a new home? Friends and others, media, social networking is riddled with fear-induced news. And all of this can cause a fear of and anxiety when it comes to investing. It's all around us, easy access to information. It's just inevitable that we're going to cover more fear-driven information. This influences our investment decisions. So what happens, what we've noticed, as we mentioned in the onset, investment fundamentals is more about mathematical equations than emotionally driven events. So why is that so? Well, you start with the good news. As we see our little stick figure jumping with joy, we've got a lot of good news in the economy. Economy is booming, home value prices are high, markets are hitting all-time highs, etc. So what happens? What's the natural emotional impact of good news? Well, there's this exuberance that, we'll never lose money. Oh, our risk tolerance is also influenced by this good news. We have an almost unlimited risk tolerance at that point. What may seem to be risky assets now we view as less risky because, well, with consistency, investments have gone up each and every year. And then our goals, of course, we try to pursue and achieve more and more goals than possibly what our means would allow. So what happens though, the emotional aspect, when we see some bad news, our little stick guy is not so happy anymore. The emotional state goes from exuberance to fear. And this unreasonable fear oftentimes results in making sell decisions, not mathematically based, but again, fear driven. Our risk tolerance, which went from unlimited, I can take on anything, to now I want only the safest stuff. And then goals shift to more restrained, less, perhaps we delay retirement, that goal. Perhaps we put off buying that home. So we restrain our goals. We're happy with where we're at. So again, that's how emotionally driven investment decisions can impact us with our saving. What it really boils down to, as you see it here, we're worried that as the markets erode, we lose money, that we're going to be out of a home, we're going to be eating dog food, whatever the case is. It's just a joke, of course. The sky is falling. But is that true? Well, as mentioned, the goal with investing fundamentals is to turn as much as we can the decisions into mathematical equations, and as much as possible to reduce the emotional aspect of investing. So to do that, we boiled it down into three key tenets, fundamentals of investments. One is we're going to talk about how important it is to set goals and expected time horizons, match the time horizons appropriately. We'll also talk about the balance between risk versus return. And lastly, asset allocation, what it is and why it's important. Let's talk about that first one. Thinking about goals and matching those with time horizon. There's a variety of possible goals that you could be saving for. There's perhaps some long-term retirement goals, and then associated with that in retirement, we have the retirement distribution goals as well as estate planning goals. Many of those can be many years, many decades. We've got education goals, other special purposes like saving for a home, a wedding, etc., or maybe just the overarching goal of financial security. So all of this can have very different time frames. Achieving the goal of financial security could be really open-ended, as perhaps as soon as possible. Whereas education has a finite. We know when perhaps our child or grandchild will be going into secondary education and we'll need these funds. It's a finite number. Retirement goals, maybe there's some deviation within a few year period of time. So we can see how the differences, the time frames, identifying those are important, because short-term goals, long-term goals, in general, the longer the time horizon that goal, the more risk that we can achieve. So first step in that is identifying that. In many cases, some, even just for the simplicity's sake, will take certain goals and they'll carve out maybe a bank account or an investment account just to achieve that goal in a simplified manner of goals-based investing. Others will just include this as part of their overall plan. So how do we do this? How do we begin to then match the investments with the time frames? Well, as we see here in just this simple chart, we typically see on the left is the potential return. Higher you go, the higher potential return. The further right you go, the more potential risk that you're taking as well. So we see here that higher risk investments like stocks and alternatives, higher risk, which we know, but yet has higher potential return. So something like treasury bonds, bills, CDs, government bonds, etc., generally have lower risk, but again have lower potential return. So the balance between these is important with matching our investment goals, because really if we want to put it into kind of this little flow chart here, all of these aspects can achieve some sort of goal, and it doesn't need to be one or the other. We could have varying shades of some of these. Maybe we want growth and income. Maybe we want income and stability, or maybe we want aspects really of all three of those as a part of our portfolio. For example, a retirement portfolio is going to have elements really of all three of these. Perhaps if we want to be saving for maybe a new home, well, this particular account may be limited to just stability. So mixing these together, you find that the goals that you need can be achieved in really one or more of these three objectives, and the investments that you choose can be matched with that. For example, a preferred stock or even some high dividend common stocks have a small element, perhaps of growth, but has a very large element of income, but almost no element of stability. For example, going further, we see bonds, corporate and government bonds, may have a great aspect of income and stability, but really no preference towards growth. So matching the individual investments, the relationship between risk and reward with really the overarching goals of growth, stability, and income. This is the first way that we can match our goals and time horizons. Now, asset allocation. Let's talk about what that is. What is an asset? Well, first off, an asset is broadly defined and often defined as either an equity, a stock, or a fixed income or bond. Those are the two main asset classes. Then, of course, cash. In modern portfolio theory, which was designed by a Nobel Prize winning economist, Harry Markowitz, he found that the relationship between risky asset classes such as stocks and conservative assets such as bonds, and found the relationship with that called asset allocation resulted, so we see here, in about 90% of the variation. So meaning that 90% of your return is dependent upon the asset allocation that you chose in a well-diversified portfolio. So why is that the case? Well, in a well-balanced portfolio, you've diversified away some of the more common company risks. And really from there, many investments, as you've diversified amongst many different investment types, the possibility of one particular investment, choosing the right perfect time to buy it and sell it is pretty much washed out. And statistics have shown that the very vast majority of investment professionals can't do that. They can't market time and consistently outperform the market by choosing perfect investments. So modern portfolio theory has found that in well-diversified portfolios, 90% of your return is really determined by your asset allocation. And it's one of the most important decisions that you would make in investing, as we allocate that to the goal, whether short or long term. Well, how do we do that? Well, in this next slide here, we're going to see just briefly here, just to explain on this chart again, off to the left, we see the return figures. The higher that we go, the higher potential for return, vice versa. And then off to the right, the further right that we go, the greater risk that we take. So very similar chart to the individual investment types that we talked about, common stocks, preferred stocks, alternatives, bonds, et cetera. We can really plot the same type of information for an entire portfolio using the relationship between stocks and bonds, asset allocation. So plotting it in really the same function here, we again notice some similarities that generally the more risk that you take, the riskier stocks, the higher potential for return, and of course, the higher risk, with some deviation to that. We notice there, for example, are all yellow dot. Bonds are for income. Now, it would make sense that bonds, being low risk in their nature, would have the lowest potential return and one of the lowest risk type portfolios. Then you look at the blue dot all the way up in the upper right-hand side. Stocks are for growth, is what it says underneath that. But again, you'd make that assumption. Stocks would carry the highest, an all stock, a 100% stock portfolio would carry the highest potential risk in the portfolio. And as you see there, off in the left, highest potential statistically for return. But notice how this particular chart here bends. In this modern portfolio theory, this is our typical chart that you see, and those dashes kind of are lined up with the various portfolios, the allocation. So 100% bond, if we added just a little bit of stocks to the portfolio, that's that first point up and to the left where it says bonds are for income. Well, notice the event. So when we add just a little bit of stocks to an all bond portfolio, notice what happens. Well, statistically, the overall risk of the portfolio actually lowers considerably. And we also notice that the return increases, which is what's expected. Notice the next event. We continue to add just a little bit more stocks to the portfolio. The return has again increased pretty dramatically. Overall risk, though, now is starting to increase. Next, we add a little bit more. And as we see off to the left, those lines, the distance in between each lines continues to get smaller and smaller and smaller. So the more and more stocks, basically, is what we're saying. The more and more stocks after this key point, this pivotal point, roughly around 40% in stocks, 40% in stocks, as you see there. After we've reached that key pivotal point, we're adding incrementally a large amount of risk to a portfolio, which is depicted by those lines on the bottom, the distance between the lines on the bottom, and not incrementally as much more added return, depicted by the difference in those lines, as you see, getting smaller, a little tighter as you go up, right? So for any given amount of risk, we can track then the overall return. So as a sweet spot, for example, with retirement income type portfolios, retirement portfolios for those who have already retired, we want to find a good balance between stability, income, and growth. We often find that a sweet spot for retirement portfolios is that area towards the left of our chart there. Perhaps that portfolio that might be almost directly above bonds are for income, our yellow dots, somewhere in that area. And really, with that particular area, we've maximized both the cost value of risk versus return. For long-term investors who are looking for growth, where risk isn't as much of a consideration, we can afford to take more incrementally, more and more risk to achieve even the smallest of increases in growth. So that's modern portfolio theory, taking it from the individual investment type, relationship between alternatives, stocks, bonds, etc., to asset allocation, as we see here, the overall portfolio allocation. So let's just kind of sum it up here. It's what we've learned, just some of the key takeaways then for us today. Well, number one, we want to remember that really the building block of investing is to, as much as possible, remove the emotional aspect of investing. And as much as we can, insert the mathematical processes of it. And that involves identifying goals and time horizons. It also measures the risk versus return that is acceptable for your investing. And lastly, the overall allocation of the portfolio, which, as we learned, really determines about 90% of the overall return in the portfolio. Well, we hope this was helpful for you today, as we just had a brief discussion about these investment fundamentals. Feel free to include in our chat any questions that you might have, and we can address them here, as we do have just a few more minutes if you'd like. But thanks again for your time. We hope to invite you back next time, as we'll have, as we did last year, another good discussion about beneficiary designations in our next workshop, our Plan Series webinar. So hope to see you back next time for that as well. So again, thank you for your time, and hope to see you again shortly.